point where the macro will take over, and possibly if the S&P drops 10%, then also Bitcoin is going to have quite a drawdown from here. I expect below 30,000 to be actually a level we're going to clear.
Traders have noted that there is a tight correlation between Bitcoin and the NASDAQ. So if you think tech stocks are falling, by extension, wouldn't you think Bitcoin is still going to fall?
Yeah, I also don't like the prospects of Bitcoin here. They are correlated for a good reason, David. So over the short term, Bitcoin prices Bitcoin attracts dollar flows or fiat money flows. And the more flows it attracts, the more the marginal price of Bitcoin goes up. Obviously, I'm not breaking any new grounds here. But what I'm about to say is that the marginal price of owning dollars, rather than pushing these dollars towards Bitcoin, has actually gotten better for an investor which wants to own dollars. Why? Because the Federal Reserve is hiking rates, and treasury yields, which are a risk-free asset basically, they are starting to yield 3%. And when you have a perspective to invest in a risk-free asset that yields 3%, while the economy is slowing down, you're going to think twice whether to put your money in an unprofitable tech or in Bitcoin, right? Your marginal propensity to buy these assets is going to be much less if the economy is slowing down, and your alternative asset, which is a treasury bond, yields 3%. Now, I can't be positive on these high beta, high volatility, and relatively speculative assets in the short term in such macro environment. So I don't like highly valued equity sectors, and I also don't like Bitcoin at this stage. Macro underlying driver, I just described it, right? So it's the economy slowing down, it's the Federal Reserve tightening financial conditions. That hits all risk assets, equities, houses to a certain extent, credit, Bitcoin, anything. Now, if something idiosyncratic happens in favor of Bitcoin, and for instance, we have had the news that Fidelity will basically start putting some of their 401ks for their clients for their employees into Bitcoin. We just recently had the news. Now, if you get something idiosyncratic like that, if you get a spot ETF on Bitcoin getting approved, if you get something that basically drives more marginal flows into the product in an idiosyncratic way, then yes, they can decouple. They also can decouple on the long term. If you zoom out and you think of Bitcoin as an asset class, it can have other drivers that are different from NASDAQ, but you need to zoom out. If you ask me over the next quarter, then I think they will remain correlated. Lower realized volatility tends to attract more institutional investors, and the more institutional sticky investors are in the asset class, the lower the volatility. So it's a virtuous cycle, effectively. Now, it's virtuous, but this, artificial stability you are creating by attracting sticky flows into any asset class actually breeds instability over the long term. Because people who are buying this asset class for the first time are relatively inexperienced. They see volatility coming down, but they treat this as an exotic animal. If you're a large institution, you're going to buy Bitcoin because you have a certain small probability that Bitcoin is going to play a role over the long term in your portfolio. The first time you see a drawdown that is larger than you expect, you're going to rush for the door. So it's a lower suppressed volatility basically that then breeds more instability over time. And as the system is more leveraged, ultimately it can lead to more temporary higher spikes even. So it's a virtuous cycle until something breaks again.
What about the $26,000 Bitcoin price level that you gave me last time? Are you still sticking to that?
Yeah, I think that's more or less where I think it lands in a situation where the S&P goes down 10% from here. And I have to be honest, Bitcoin, gold as well, they're holding their ground relatively well in such an environment. I mean, if you have equities going down 10%, then you have unprofitable tech going down, I think, between 40 and 60%, depending on which stocks you have, David. And then you have Bitcoin going down since the beginning of the year around about 12, 13%. I mean, you have to admit, it's actually holding on pretty well compared to these risk assets.
Well, Bitcoin, we're going to touch on gold now. But Bitcoin, just on that note, it's bounced up a little bit on Wednesday, but it's had a pretty rough week because, again, the NASDAQ had a really rough week as well. So I guess this correlation has been holding up quite well.
Think about that. So if I look at the implied volatility of Bitcoin annualized, that's around about 60%. If I look at different option contracts right there. So that means that on a daily basis, Bitcoin is priced in to move around about 4% a day, up or down, 3.5 to 4%, give it or take it. Now, the Nasdaq, if I look at the implied volatility in the Nasdaq, on an year, that's about 25% a year on average. So that's basically less than 2 times volatile as Bitcoin, which should also mean that if Nasdaq has gone down more than 10% year to date, then Bitcoin should be down 25% year to date on a beta adjusted basis. And it's not. So it's been pretty resilient, one has to admit. But I think this resilience has been driven by some idiosyncratic news we have seen throughout the year, which has been supportive for Bitcoin. For instance, we have seen, when sanctions were applied on Russia from the US, there were first speculations that Russia would start to move some of their assets towards digital assets, for example. That supported and brought a bit towards Bitcoin. There has been some idiosyncratic news. I think now we are at the point where the macro will take over, and possibly if the S&P drops 10%, then also Bitcoin is going to have quite a drawdown from here. I expect below 30,000 to be actually a level we're going to clear. Yeah, well, if a beta adjusted drawdown like I described happens, then I expect it to happen within the next 3 months. So the target below 4,000 for the S&P I have is for Q2. So that's remaining 2 months from now. I would expect such a drawdown to have an impact on Bitcoin price as well. So within the next 2 to 3 months is my answer. Yeah, well, gold as well has been holding its ground still relatively well. I mean, think about it. Everybody knows and pictures this chart of gold against real yields, right? Now, if I calculate real yields in a slightly more technical way, like I do, I look at forward real yields, long-term real yields. The move we have seen here to date is massive. These long-term real yields I'm looking at were around about negative 80 basis point to start here. They're now positive 10 basis point. It's a 90 basis point move in real long-term real yields on a 4 months basis. That's very, very large by any metric. And look at gold. It's up year to date. I mean, it's slightly flat now, but it has been up even 5% in this environment year to date. So the resilience out there has been pretty impressive. Even then, I think from now onwards, as you have the Federal Reserve extremely committed to tighten financial conditions, what's going to happen is that these real yields are going to start moving even more north. That makes owning dollars more attractive on a marginal basis. That means owning gold temporarily less attractive on a marginal basis. I have to expect gold as well to drop a bit from here. Similar to the discussion we had about tech, when real rates go up, then obviously your alternative investment, risk-free investment, which is treasury yields, start to become more attractive and money flows that way rather than flowing towards gold or the Nasdaq or Bitcoin for this sake. So normally I would answer yes, but in this case, David, we have a problem. The problem is that inflation expectations are starting to become de-anchored. We are starting to have traders pricing in a meaningful probability that inflation will print above 5% over the next 5 years. If you're a policymaker, you don't like that. You really don't want to see that happening. You really don't want to see people expecting inflation to remain sticky and up, or otherwise they're going to demand higher wages, which is then going to pull inflation even higher. This is not what you want to see. So I'm going to argue we're at the point where if inflation becomes sticky high, then policymakers are going to react in a non-linear fashion anymore. They're going to really make sure that rates are hiked to much higher level, and that hurts gold. Because ultimately, the way you bring down all of that is by making real rates higher. So by bringing nominal yields even higher than an already high and sticky inflation. And in that environment, that's basically a Volcker-like environment where you do your utmost best to kill this inflation beast. And in that environment, gold doesn't thrive because inflation expectations are getting out of hand, and policymakers are not going to like that, and they're going to react so aggressively that they're going to basically kill about any asset class if that happens, including gold. I have to say that there are some long-term tailwinds behind gold.
Sure.
So because of the sanctions, right, that we have seen applying, and the weaponization basically of these sanctions, well, you have to argue that some central banks out there are going to start stockpiling gold instead of owning fiat reserves. So over the long term, because of real rates ultimately having to go down to make sure the wealth effect isn't impaired, gold has some tailwind. But short term, I would expect also gold to have some trouble. Basically, I'm telling you, this is an environment where you have about nowhere to hide. You can't buy stocks, you can't buy gold, you can't buy Bitcoin, because do you remember Q4 2018? Do you remember the period between November and December 18, David? Nothing worked. No asset class delivered a positive inflation-adjusted return. I think the macro environment we're facing now is very similar to that. So you just have to be patient. You have to raise your cash allocation. I know it feels uncomfortable with these spot inflation levels, but it's actually sometimes better to be defensive than to be offensive where the macro environment doesn't allow that. Credit creation is the process of creating new money that are spendable for the private sector. That means it's the government sending you checks at home or cutting your taxes and increasing your spendable amount of money, or is the banks lending more money to you? And last time we've seen fiscal stimulus being sent to Americans or actually credit being thrown to the private sector was 2021. Since then, not much has happened. You didn't have any fiscal impulse, any large fiscal deficits, and banks are lending, yes, a bit, but not much. On the other hand, monetary policy is getting more restrictive. You have real interest rates going up, you have hikes happening all over the place, and you have central banks telling you they want this to happen. So in this environment where credit creation decelerates and the relative monetary policy stance gets tight, you end up in this bottom left quadrant, which is what I call the just sell everything quadrant. There is nowhere to hide in this environment. And what you want to own there is just dollar cash at the end of the day and some protection on your risk assets. So some volatility, some VIX, and some dollar cash. Anything else, I'm sorry, but it doesn't work. That's basically what happened in Q4 2018. And you need to be patient and move back to one of the quadrants for which you either need central banks to ease again, or you need governments to step in and stimulate again the economy, or banks to lend big times to the private sector. That isn't happening now.